just to give you a little bit more, I'm from Jamaica. You probably picked up from my funky accent here already. But I've been here since 1996. And I came from college and graduated and got to work for Verizon for a little bit. You know, Verizon, a little bit company. But I got laid off after about 4 years. You know, I was doing, doing pretty well. I was following that formula. Go to school, get good grades, and because after you get some good grades, then you should get a good job, right? Is the idea. So I did. Verizon is a pretty good company. Then I got laid off, and I was like, wait, where's that in the plan? You know? And that's when I started changing my mindset a little bit. So, I got to do something. But that's kind of how I got involved with my whole idea, personal finances, and doing something different. But since that time and now, yeah, my cash flow has increased tremendously. I have real estate properties in the Metroplex. I have a tax business as well. And I enjoy teaching this stuff. I used to teach back in grade school, high school physics. I had a lot of fun doing that. I love teaching and seeing that light bulb go off, I enjoy it. So this room is for new folks, people who have just gotten the package, the MyEcon package, or I know there's some people in the room who have not yet got the package. By the way, show of hands, who has not yet gotten the MyEcon package? Okay, that was small. Okay, cool, perfect. Just so you know, at 12:45, I think it is one, we'll be having an actual overview, MyEcon overview presentation in one of these rooms. So if you want to hang out for that, especially if you haven't seen one of those before, then that would be good for you to stick around. And if you have any friends in the area, go ahead and text them down to come. All right, so what we're going to do in this room again is that we're going to start with what's called tax strategy. I like to call it tax planning. We hear about tax preparation all the time. Sorry. We hear about tax preparation all the time. We hear about tax preparation all the time. As a matter of fact, this is the season between January and April. And most people don't do planning. They just do tax prep. And here's how you can test it. If the only time you think about taxes is between January and April, then you haven't done any planning. Right? Right, it's too late. December 31st ended already, right? There's nothing that a tax preparer can do legally to go back and fix the mess you made in the year that already ended. See? So I tell people, wherever we meet you, if it's January, February, March, it doesn't matter. Let's start putting some plans in place, some steps and strategies in place, so that you can maximize your tax advantage or minimize your tax advantage legally. See? And that's why I call it tax planning. Businesses do tax planning because they hire sharp people from Harvard and Yale, and so they understand how taxes and finance work. But individuals don't do that. We go to work, we make the cash, and we lose it. For those of you who have seen me present before, I like to start off by drawing a picture of a house on the board, on the whiteboard. And what we do is, if you can picture that house, on the left side of the house, you have just point an arrow into the house. Because that's what you do. You try to bring money into the house. Because you go to work every day, you go to work, you bring it. Nothing messes with that. That has to happen. But we typically forget or ignore the back door, where the money is going out. And I draw 3 arrows coming out of the right side of the house. So picture that in your head. One arrow is taxes. You're losing 30% minimum in taxes. You're going to lose another 20% in interest that you pay on debts, student loans, car payments, all that stuff, right? And then the third arrow is just your expenses, car loans, and all that stuff, right? So what we have to get good at, if we're trying to be financially successful, is yes, go ahead and bring money into the front door. Do that. Make that bigger if you can. But we cannot ignore what's going on outside. And sometimes we think it's taxes, so we're scared, you know, it's IRS sometimes, the government, take it. And we tend to even overpay them because we don't understand, etc. I had a chance to go on the radio here in Dallas for 6 weeks in a row, on one of the local radio stations. And one of the first things I told the Dallas, because this was live, was I don't blame the IRS like how a lot of people, always kind of down them out. So I said, I blame us because we don't read the tax code. We don't know what's in it. And if we knew what was in it and we used it to our benefit, then we'd be ahead of the game. You see? And lo and behold, there's a lady that used to work for IRS who was listening and she called me. And she gave me my, little kudos and stuff. Because she appreciated that I didn't beat up on the IRS, So anyway, so here's the strategy. Let's start out with this. Hopefully I can figure this thing out. One just, definitely. But anyway, we figured it out. So we're going to talk about the W-4. So the W-4 form is, if you guys remember, when you got your job, for those of you who have one, in your new hire packet, you would, in your new hire packet, they would include a W-4 form in there. Actually, you guys should have a common tax deduction packet. Do you have one? Yeah, let's see what that one. Okay, no, you don't have it. You don't have it. It's okay, I'll show you. Okay, that's fine. So the W-4, I'm trying to get it to you. This is an older one. We're going to update our documents to bring in the 2015 W-4 form. But are you guys familiar with this? Yes. Yeah. Okay, so the W-4 form, as it says right here, I know you can't see it. I don't know how to make it bigger here. It says, I'll read it to you. It says the purpose of the form. It says complete form W-4 so your employer can withhold the correct amount of income tax from your pay. It says consider completing a new form each year because your situation has been changed. Now, some people have been on the job 10 years and they never touched it. So the IRS is telling me consider filling out a new one. People think this is a dependent worksheet, right? Typically, people put 0 or 1 on this form and then they hand it into their payroll department. And most times, they don't really read it. They just put whatever they had last job, they just transfer it out to this job. Or they call up mom and say, Mom, what should I put in my W-4 for? And mom says, child, put 0 on that thing. You don't want to mess with the IRS. Now, I do taxes. I've been doing it for a long time. I have plans coming in and out. Guess what? Most people put 0 or 1 on the W-4 form. That means that the IRS takes as much as they can. Okay? So you give it to them. And at the end of the year, like this time of the year, we're so in a hurry to get a refund. My thing is, that's not smart. Not financially, not mathematically. Now, emotionally, it might feel good to get this fat refund. One guy told me, I got $5,000 back. I told him, that's not good. He's like, why not? Well, look, Uncle Sam kept your money. And most of you know this. He kept your money all year. Didn't pay you one dime in interest. It would be better you took that money and put it in the bank. Let it grow at least, right? And then if at the end of the year you owe, then at least you have the money that did something good for you. Make sense? But we take it a step further. We say take your money and do something constructive with it. Take it now. Don't wait. At the end of the year, shake hands with the IRS. I don't owe you, you don't owe me. That's the right way to have a W-4. Make sense? Yeah. So now let's do what most people really have not done. Let's just read it. That's all we do. Let's just read it. All right. Line A. Keep a mental note. If you don't have a copy of this, which I don't think you guys do, just keep a mental copy. Good. Keep a mental note of but I'll take A1. Scroll back to this. All right. Keep a mental, make it just enough smaller so I can see the light from there. Yeah, perfect. Everybody can see that?
Yeah.
That's one. All right, so keep a mental check. Enter 1 for yourself. Enter 1 for yourself. So everybody should at least have 1, not 0. Next, enter 1 if you're single and have only 1 job. Or you're married and have 1 job and your spouse does not work. Or your wages of your second job or spouse's wages is less than 1,500. 1,500 or less. So figure it out real quick. If you have one more, put 1. Next. By the way, people think this is a dependent worksheet. Did I ever say that?
Yes.
It hasn't asked you for dependents yet. Okay, let's keep going. Enter 1 for your spouse. Period. You see that little period right here? In Jamaica, we say full stop. It's a British thing, you know. You call it period here. All right, period. So if you have a spouse, enter 1 for your spouse. But it continues. So that we can take some more money from you, go ahead and you may choose to enter 0. I didn't really say that way. That's what, in effect, that's what's happening. Okay? So you can put 1 more on C. Some of you have 3 so far. Some of you have 2. Some of you have 1. More than 0, for sure. Let's keep going. D, enter number of dependents. Finally, they ask us for our dependents. It's not a dependent worksheet. Okay? So if you have 2 kids, put 2 kids. 1, 0, whatever. E, y'all following? E, enter 1 if you're a head of household. Now, the question is, are you head of household? Well, people say, well, I'm the head of my house, so I'm the head of my household. But according to the IRS, let's just go read it. Well, that's all we're going to do today. We're just going to read the code. You see, I like to go directly to the IRS documents and read it. It's right there. Head of household. Generally, you can claim head of household filing status if you are unmarried. That's 1. But you see the word and, you get 50% or more in the upkeep of a dependent. So you have to be unmarried and have a dependent. A kid, a grandmother, something, okay? Someone. So now you can tell if you're head of household or not. All right, so if you are, then go ahead and enter. Where are we? Thank you. E. F. We just finished E. F. Enter 1 if you have at least 2,000 in child dependent care. So you put your kid in daycare and you have over $2,000 for the year. So enter 1 if that's the case. Who has more than 4 so far? Okay. All right. G, child tax credit. It says if your total income will be less than 65,000 or 95,000 if married, enter 2 for each eligible child. So if you have 2 kids, and an eligible child will be a child who in the tax year is no more than 16. So that's how you can tell if you have an eligible child. In that tax year, the child has to be no more than 16. Okay. 2 for each child. So 2 kids, that's 4. But if your income is less than, where am I? If your income is between 65 and 84, then you just enter 1 for each child. Got it? All right. So that's another. The next one says what? Add them all up. Add them all up. All right. Now this is interesting. What kind of numbers do you guys get? Shout out. 5, 3,
7,
15.
6.
15. Who said 15? Really? On the first page? Wow. Exactly. Guys, you can put between 0 and 99 on this form. I told somebody that said 99 kids. It's not a dependent worksheet. Many things affect this form. It's a very powerful form if you use it right. I've used this form to help people to bring home an extra $500, $600, even $1,000 per month immediately. I show them how to change the form correctly. We apply a tax strategy. They take it into their payroll department Monday morning, and as long as it hits payroll before they run it, they'll see an increase in their paycheck. Now, the question that you're thinking probably is, well, am I going to owe? Well, that's why we have the rest of the strategy, the other side of the strategy, so that you don't owe. Because what we're going to show you next is how to reduce your taxable income in the first place so that you can afford to get this money up front. That's what we're doing. We're balancing it out. See? Because some people, will go and they will adjust their W-4 form because they need the money, but they don't have any other thing, no other strategy. So guess what they have to do? Halfway in the year, they have to hurry up and put it back. Or they run the risk of owing big time at the end of the year. Makes sense, right? We know this, but we've been around, we've been working for a while. If we haven't done this, we know somebody who's done that, right? What we say is, let's get this thing adjusted correctly and even. Okay, important piece here is that this has 2 pages. Some people have never seen the second page of the W-4 form. Matter of fact, the W-4 form is really just here, just this part. One guy told me he only got half page in his employment packet, his new hire packet, and they cut it because they know he's not going to read the instructions. They just cut it so that they could save money on printing the paper. And they put a couple of sheets on the one 8.5 by 11 page. They print it and they cut it and they hand it out to the employees. So they didn't even get a chance to read it. They know they're not going to read it. So it's crazy what happens out there. All right. So it says, let's turn to the second page if you want to know. If you want to claim adjustments to your income, or you want to if you want to claim adjustments to your income, or you want to reduce your withholding. Well, yeah, I want to reduce my withholding. I want to get them out of my pocket. So let's go to page 2. Page 2. Page 2. Page 2. All right. This box right here is what we're going to focus on today. This box has the potential to give you another 5, 10 more points, in addition to the 5, the 4, the 3, the 15, or whatever you have already. You understand? Now watch this. First section. Enter an estimate of your 2014 itemized deductions. You know what itemized deductions are? Who does taxes in here? Cool. So itemized deductions, that's where you would have things like, if you have a home that you're paying for, you'd have your interest. You deduct your interest and your property taxes and charitable contributions, and insurance. Even medical, yes, that's what I'm looking for. Medical. All right. So if you most people in this country, this won't qualify. You won't qualify for this because most people are not buying a home. Most people are renting. So the biggest thing on the Schedule A or itemized form is what? The interest on your mortgage payment. Exactly. So if you don't have a mortgage interest, then typically you're not going to qualify for that. As a matter of fact, some people tell me, "Oh, I got my charitable contribution." There's one seat up here. Is that seat available?
Excuse me. Any of the members that are here that have a quick start packet, can we pass them over to the end of your rows because those are for the other room? So on the front of that page it says quick start packet.
Yeah, they're probably starting over there.
Yeah. He won't speak on this stuff in this here.
And we can get your copy of this later on too.
Right.
So
That's it. I think this would be fine.
yeah.
Thank you.
Thanks, guys. And for those who just gave it, we can get that on top. Go on. How's it going, guys? I think there's one seat back there. Is there a seat available at the back?
I don't know. She kept coming back.
Okay.
She knew.
Okay, so let's carry on. I was gonna make a point here.
The interest on the house.
Right. But okay, yeah. So some people will tell you. I've had some clients that will come into me and they'll say, like resident clients, and they say, last year my tax preparer deducted my medical expenses. And I said, okay, cool, let's see what you have. Well, medical expenses has to be really high before you actually qualify for it. It's done up to 10% of your income. You have to be really, really sick, or you spend a lot of money in that hospital for you to qualify for that. But typically, the tax preparers don't really tell people that. They give them, their customers come in and they give them all their documents, and they leave believing that it was deduction because we know it's a deductible item, but most times they qualify for it. Same thing with you know, if you go to church and you give a lot of tithes and offerings, you're almost here. This is deductible. This is deductible. It is. But most people don't qualify for it, and they don't even realize it. Because again, they go to their tax preparer and they give them their documents, including the little note that you get from the church saying how much you actually paid last year. But if you don't have a Schedule A form, if you don't have a house, typically you won't qualify for it. See? So these are the type of things that I try to help people understand as they come through the office. So you want to pay attention to that. So let's go just with this. The best way to treat this, by the way, is look at your last year's return. If you can remember what it looked like, whatever you had on your Schedule C form, I would just drop that number right there. So anybody have a calculator handy? I'm gonna do a little math here. So somebody help me out. One of the members, let's get a calculator handy so we can do some math. I'm just going to do an example of this to show what it looks like. Okay. All right. So let's say you are somebody who has a house and you're paying interest, etc. Okay, let's run that example. Okay, boom. Go ahead and put down. So first one, calculator. Write this number down on a piece of paper. I don't have a whiteboard up here. Write down. What's a good itemized number? Let's say 13,000. Write 13,000 on that one. If you're doing this on your own, if you want to do this by on your, as it relates to you, if you don't have a house and you don't do this normally, just put 0 on line 1. So on your page, you're gonna write line 1, let's put 0. And I'm gonna show what happens. Make sense? Nobody confused you all. Good. By the way, some people tell me that they can't understand when I talk, so my accent is too strong. If that ever happens, just stop me. I don't feel bad. I have to repeat. Next, 13,000. Next one, down here. Based on your filing status, pick the one that relates to you. So if you're married, put 12. If you're head of household, put 9. I mean 12,400, put 9,100, and put 6,200. This is your standard deduction number. So when you're doing taxes, the IRS will give you a deduction, standard deduction. Everybody in this country will get one, automatic. But if your itemized deduction is bigger than the standard deduction, then guess what? It's best to take the itemized deduction because you want the biggest deduction you can get. So this is what we're comparing, and you're going to see that line 3 is going to say subtract it to see what really the difference is. Now, this is old. This is from 2014. This is going to go up by about $100, I think. But for now, just put it like that. Okay? I just wanted to give that disclaimer.
It's 200.
It's 200 now? Mm-hmm. You went up by 200.
Okay, you have
6,200 right now?
Oh, I'm sorry. 100.
100, right.
Okay.
So
I was going to the first number up there.
Oh, I see. So it would be, what, 6,300, right?
Yes.
Right. And normally it goes up around $100 a year. So, thank you. Appreciate you. All right. Everybody with me? All right. Line 3. Subtract 2 from 1. So the one who is helping me out, who's helping me? Who's got that? Thank you. So you should have 13,000, and you're gonna minus. Let's do head of household. Let's do a head of household person. So maybe this person owns a house and they have a child. Okay.
3,900.
So on line 3 you have what?
39.
3,900. Thank you. 3,900. For those doing your own math, give you about 15 seconds to do your calculation. Okay, by the way, sometimes this confuses people because if you have 0 here, let's say you don't have a house. If you have 0 here, and then you put, let's say 6,200 here, and then it says subtract 2 from 1, they're like, wait a second, that's 0? Where's that? Well, it says subtract this number from that number. It always confuses people for some reason. So if that's the case, you're going to end up with 0 because that's a negative number if you try to do that math, right? And what do they say? If 0 or less, put 0. So you're going to end back with 0. Okay? All right. Where are we at? 4. Are we at 4? All right. 4 says enter an estimate of your adjustments to income. Now, here's where the idea of becoming a business owner would help you. Most people who just have jobs only, line 4 is not going to happen, really, generally speaking. But for us who have businesses, line 4, you know that the idea is that you're going to take the business tax reductions. You understand that, right? That's huge. And let me just refresh your mind a little bit. I'm sorry I don't have a board up here, but if your income is about $60,000, let's just say that's your gross income from your job. Uncle Sam is going to come in and he's going to give you the standard deduction and the exemptions, and he's done with you. Okay? Yeah, you're going to get some credit here and there, but just as far as deductions are concerned, the IRS will give you a set number to deduct. Make sense? When you do that math, what's left is called your what? Taxable income. So far, so good? You're done. On that taxable income, you're going to now look at the tax table to figure out what your tax should be based on that income. Okay? Then that's what you pay. Let's say that number is 10,000. Well, what they'll do is they'll take out some from your paycheck, each paycheck, so that you don't have to pay a whole 10,000 at once. If you pay more than 10,000, they give you a refund. If you pay less than 10,000, then you owe. Simple, right? That's tax preparation. Done. If you're not in business, that's what it looks like. We tell people get in business at the next year, and then we give them a my income package. Why? One of the main reasons from a tax advantage standpoint is that now that person who's making $60,000 on their job would be able to deduct $25,000, $30,000 in business expenses. People say, well, that's a lot of money to deduct in business expenses. Well, I'm going to ask you a question. If you're making $60,000, let's say you're, head of household or single, whatever, is it fair to say that you're going to spend $30,000 on some stuff? Travel, gas, food, light,
Cell phone.
stuff. Am I right? I mean, it's all gone by the time the year is done, so you spend it on something. You see my point? Now, what we have to get good at is learning how to convert some of these monies you're already spending, the 30,000, convert those to business expenses. Now, here's what I've done for the last 12 years. I made my income from my job. Then for example, I look at an expense like this, right? So we all got one. Whatever this is, $1,200 a year or whatever. I deduct 80% of this. Before I was in business, guess what this was? Just a cell phone that I paid 100%. But now the government says every dollar that you can tie to a business expense, legitimate business expense, you don't have to pay a tax on that dollar. That's what's happening. So what we're pretty good at in my econ is teaching folks how to now do business as you live your life, just do business, and convert those expenses to business expenses. You understand? So this week, I'll tell you right now, my phone's been blowing up because we had this meeting going on, and we're planning, and I have guests all over Dallas figuring out, hey, where to come, and I'm talking business on my phone. But yeah, my wife calls me too, and I say, hey, how's it going? That's personal, right? But guess what? This is expensive. I'm trying to show you where that 30,000 is going to come from. You okay? You drive your car. This year, the government will give you 57 cents for every mile you drive your car. It's going up. Every year it goes up. People who are in business get that. If you're not in business, here's what you're doing. Every 2 miles you drive to work, roll your window down, take a dog, throw it out. Drive another 2 miles. Take it down, throw it out. Every day. That's literally what you're doing. And for Marilyn right here, who's in business, she'll come up and she'll pick it up. Every day. Because she's in business. The government pays her for going to and from if she conducts business. It's really easy. I love my econ because, everywhere we go, everybody in this country pays taxes, right? But they shouldn't. So when I go somewhere, I say, Larry, how's it going? It's good meeting you. If you know anybody who want to reduce your taxes, get out of debt, start investing, have them give me a call. Now, that activity was business related, was it not?
Yes.
All day long. Now I can deduct my mind that I drove to this spot. If it's 50 miles, I'm going to deduct it. I guarantee you. We have a tax record keeping software that helps track that stuff. We'll get to it. I'll show you. So it makes it really easy. It's the difficulty out of this stuff, right? 57 cents is what I got for every mile. It doesn't even cost you 57 cents to drive your car a mile. Does it? Unless your car is just a clunker and it's just sucking gas and burning oil and all that, it's not going to cost you that much to drive a mile. So the government is really being liberal, giving out some money if you're in business. If you're not, you get squat, as they say out here. All right. I hope I'm making sense. Now, let's bring it back to here. I'm sorry, I kind of went over here just to explain that. I'm trying to explain what's going to cause your income to adjust. See, that 30,000 is what's going to cause your income to adjust. Because we're going to now subtract it. We're going to treat it like a tax deduction, which it is. And it's going to cause your income to adjust even lower. Make sense? So now, guess what you have? You have a lower amount of taxable income. But that's not the only thing you have. Your tax bracket now slid to the lower end. See? Y'all know that there's something called a tax bracket, right? So it's between 0 and 39.6%. So the more money you make, you slide to the higher end. So those Dallas Cowboys players who bringing it in, those guys are closer to the 39% tax. Guys on the other end, not making a whole lot of money, they're going to be close to 10%. So if you just reduced your income by 30,000, guess what you did? Two things. Again, the amount you're getting taxed on is lower, and your tax bracket is also lower. Two positive things. So go ahead and put in, put in 25 grand, $25,000 online for. And where am I getting that? Again, it's no magic number. It's just, I'm just looking at it. Somebody making an income of 60,000, surely they can deduct 25,000 if they really focus on record keeping. Okay, it's not going to spawn in your lap. You got to do some work. You got to keep records. You don't want to show up at the end of the year to your tax preparer and you say, I'm in business for myself all year. And he says, okay, where are your records? And you say, well, I don't know. Then legally, he can't give you anything. You got to keep records. So that's why we have software to help you do that. Cool. But if you can't do that, go ahead and put 25 on this line and be aggressive. Come to training. Go get on the webinar because we teach you the strategy. What we're doing, what we do in the overview meetings that you guys may have gone to is just an overview. When you come to these things, we actually get down and show you how to get it done, which we're gonna do some more of that. All right, I gotta speed it up. So where are we at now? Line 5. Line 5 says add 3 and 4.
28.9.
28.9. Very good. Line 6. Enter an estimate of your non-wage income. So people who have stocks and bonds and dividends and all that kind of stuff will typically put money there. But guess what? Most people are investing a lot, so let's skip that for now. If you have some, put some. All right, just for example, we keep going. Where are we at? Help me out. 7. Subtract 6 from 5. Oh, 6 was 5 was 0.
28.9.
Yeah, so that number is going to carry on. 28.9, right? 28.9. 28,900. Okay, thank you. Sorry. All right. We're at. Business income. So business income, we will put it. No. We don't put business income on this. We're not going to put the actual income. What we're putting here is the IRS is saying, we know that you're in business, and we know that you're going to have $25,000 or so of tax deduction. So we're not going to take all that money from you in your withholding. This is what we're trying to figure out. You're trying to figure out how much should we withhold from your paycheck. You see what I'm saying?
Yeah.
Because really what they're trying to do is balance it out, so they don't take too much from your paycheck. Yes, it's just estimate. So we're not going to put the income on this. Good question. So divide the amount on line 7 by 39.50. So take line 7, put that number in, divide it by 39.50. This number actually, by the way, for those who are curious, is what they give you as the what they call exemption. This actually goes up too every year. It's probably going to be 4,000 or something this year.
It is 4,000.
It's 4,000, right? Okay, cool. So divide that number over there. Divide that, whatever that 1,000 was by 39. You got it? What you got?
7.32.
7.32. But they said to drop the fraction, so just 7.
Okay.
Perfect. You notice it's not a dollar amount anymore. It's just a number now, right? All right, so put 7. Then line 9. Line 9 says, enter the number from your personal allowance worksheet, page 1. That number that you all shoved out of me, that's the number you should enter there. Now, let's see what the scenario would look like. Head of household, the kid, 1, 2, 3, 4, 5. So put 5 there. I'm not. Because that's what that person, in this scenario, that's what that person would be. 5 or 6, something like that. All right, ready? Line 10. It says add 8 and 9. Add 8 and 9. For those of you doing on the side, how much is that for you? Everybody else was doing it on Friday?
11.
11. 12. 12. Then what does the IRS tell you next? They say, stop here and enter this total on line 5, page 1, which is back on the other page, where you would normally put 0 or 1. That's where you put 12. Or 14. Yes.
Back to from H when you said that as a head of household person would be, because mine came up on the front was 7. Why did you say between, it may be between 5 and 6?
Wait a second. You said H?
Yes, H on the first sheet. When we're going to bring that number from H on the first sheet to number 9 on the second sheet. Why did you say it's be between 5 and 6 instead of I came up with 7?
Oh, as a head of household?
Mm-hmm.
Okay, 1 child?
Yes.
Okay. Well, that's what I was guessing.
Okay.
So it would be more.
Okay.
I was actually trying to do the ABC thing
Oh,
in
okay.
my head.
All right, thank you. All right.
Good question.
Mine is 12.
You pay attention. I was testing you. All right, we're at. Oh, so we're back here. So this is what people do now. So, I mean, this is what you want to do now. You want to take that number and drop it right there. The highest I've seen is about 87. Wow. Yeah, I literally say 87. And it was done correctly. Because your income affects this too. The amount of money you have, the amount of the itemized deduction, all that stuff affects this too. Make sense? Powerful form. Now, I'm not going to take time to do it, but there's a form right now. There's a document called Publication 15. You can go to the irs.gov anytime. Publication 15. That document will tell you now how much your employer is taking out your paycheck based on the number you put on this form. And you'll see it has all of the pay periods or whatever. You have single, people get, okay, so you have single, you get paid bi-weekly. You have single, you get paid monthly. You have married, you get, all of the categories are in this book. Your employer has a copy of it. More likely, electronic, but they have a copy. And if you tell them 0 right here, they look at your status. If you're single and you get paid bi-weekly, they look at what your pay is. There's a column on the left that shows you. I have time, I'll show it to you. But it shows you how much you make, gross. And then if you go across the top, it shows you the amount that you put on your form. 0, 1, 2, 3, 4, 5, 6, 7, 10, all the way across. And then they go down the line and it shows at 0 and $2,000 monthly or whatever, I will take out $300. If you slide it to 10 or 11 or whatever you guys have got, then I'll take out $20. That's how, if you change it, you get a big fat pay increase immediately. Question? All right, we'll be here all day. So if you think of something, just ask me. Okay, so that's humongous. Humongous. All right. So now let's look at. I'm familiar with this form here. Question, yes, sir. Yes.
Can your employer tell you that your number's too high? Because I've had an employer do that.
Yeah, they can tell you for sure. But it's none of their business really. Because what if you had 10 kids? They might look at you and say, you don't have 10 kids. Come on, change that. Nobody has 10 kids anymore. Right? Now, I literally had, this is a good question, because I literally had one of my business partners called me one day. She was at work, and she said, my HR department is trying to tell me that I can't put 13 on the form. Can you talk to her for me? And she was right there beside her, so she put her on the phone. And then I said, well, ma'am, it's not really a question. Because she was thinking, it's amazing how much HR knows about stuff. You'll be amazed. Because that's another thing. I tell people, look, let's just read what the IRS says. Let's just read stuff. Let's not listen to what people think and their opinions. Let's go to the source. But good question. I had to kind of explain to her, and then she's like, okay, whatever. And so she changed it. You can change it anytime you want. You can change it Monday morning, and then change it Friday back to whatever you want. It's your form. As a matter of fact, this doesn't get reported to the IRS unless it's over 11. Your employer holds this form in their file because it's called an employer withholding certificate, is what it really is. And the only reason why they report it to the IRS, by law, they have to, I think it's 11 or 12. If it's over 11 or 12, there's nothing wrong with that. They just have that rule in place because they want to. The IRS may call you depending on what you put on there and depending on your track record, because they have all your taxes for years and years. And if you normally owe or whatever, they look at all that and they may decide to call you and say, we got to your W-4 form from your employer and we saw 20 on it, or 22. Just want to make sure that you understand what's going on because you may owe based on your track record. You kept owing, so we just want to know that nobody else goes to your head and say, hey, put 22. That's all it is. If at the end of that call, a matter of fact, there's a case where they told one person that they had to. I don't know how that works, but they told them that they had to change it back to whatever. But because of their past, their history.
I know how that works. That happened to me.
Okay.
I had my withholdings really high, and something happened that I owed the IRS. And so the IRS informed my employer not to allow me to take that number back up that high.
Exactly.
So but then after about a year, as long as I justified it, it went back up. Yeah.
So it depends on your history and all that kind of stuff, Make sense? So it's your form. You do whatever you want with it. Look, the whole idea. Let's back up a little. What we do in my econ is we have a holistic approach to finances, to personal finance. Sometimes you think, let me repair my credit. You hear people say, I'm going to repair my credit, so so that will help me, Well, it's going to help you to get some debt. You see? No, I'm not saying it's bad. You want to get your credit the best as you can. So don't miss the point I'm saying, but that's just one part. Let's understand how taxes work, because you lose a lot of money unnecessarily if your tax situation is messed up. That's one. One second. I'll come to you in a second. Then debt is another thing, right? We have a lot of debt, so let's talk about that too. Then income, that's another thing, right? Let's talk about that too. Then investment, that's a huge thing. Expenses, a huge thing. So we have a holistic approach. Yeah, question at the back. Question?
Yes, back to what she experienced. How can IRS take our right in telling us how many allowances if we're able to justify it? Even though she owed, shouldn't they have provided something where she could make a payment plan to take care of paying those taxes?
Right. And that's a separate thing. They typically do that. They typically make a payment arrangements, etc. over here. But that's probably even a totally different department too. And sometimes, these persons not talking, it happens all the time. They don't know what these people are doing.
Right.
That's one other area too. But
right. But even if that is the case, you're still violating this person's right to say you need to lower your allowances.
Right, and.
Because because now they're putting fear in us.
Right.
You know, like, oh, okay, I'll do it, but look at all the money she's leaving on the table.
Right. And that's true. I mean, there's probably something in the code that I don't know. The tax code is 60,000 pages thick.
I know, but I mean,
So
it's
there
right
may be
back to
something in
trying to at least challenge and ask
Right,
questions.
exactly. That's true. And I would do that. I mean, if it's worth it to you, you know.
Definitely, I
Because
just
you
waited.
can spend a lot of time with IRS
I know.
on the phone and on that. So if it's worth it to you, then, you know, you can challenge that stuff. But I agree. You know, people look at the tax code and they get scared of it. And some people will say, you know, it's by design, you know, make it complicated so we don't understand it. I don't know. But, you know, but I get your point, you know.
Thank you.
Yeah.
Some people may ask the question, do I have to have earned income tied into writing off business expenses?
Right.
And talk about that a little bit.
Earned income, well, if you, let's say you are retired, okay, and you know you get money from Social Security, well, typically you will have a W-4 form for sure, and there's some restrictions in place where if you make too much money outside of your Social Security check, then you can probably owe some money, right? Because typically they're not going to tax you again on your Social Security check.
But that only goes up to a certain age, after that shouldn't be.
Right. So there's some restrictions in there and there's some rules around it. But for earned income,
Well, let's say, for example,
you'll still be able to do deductions if you have legitimate expenses.
I mean, some people, I think they think in their mind, well, I'm just starting this new business, my income, right? And I haven't, you know, I made like a minimum amount of profit over the course of the year. So then I write off
Right. Gotcha. I see. So earned income from the business itself. Yeah, exactly. And that's what we're going to go to next. So that's actually a good segue. I'm going to go and show you some scenarios where that's true. All right. Schedule C example. You know what? Let me go back up and then schedule C. All right. What I'm going to do here is I'm going to ask you a question. Let me go through this. This will help answer that question. All right. This is your 1040 form. Everybody does one of these every year. You know, you put your name, last name, all that good stuff. Just because information. Social Security over here. If you have spouse, you can spouse name right there. Filing status right here. You say you check out. Head of household over here. If you have some dependents, you go ahead and put them here, right? Kids, etc. And you'll have your total number of exemptions right here. So you remember that number on the W-4 that was 3950 that you divided? Remember that 3950? That's actually the exemption. So what they'll do is they'll say whatever number comes here, you multiply it by 3950. And that's the amount you're going to get in deduction for exemption. So that's why people say if I can claim this kid, then it makes my deduction bigger because that's what's happening. This kid, and this kid makes it 3, 4, which is yourself, multiplied by 3950. Right? So I'm just trying to time that back to you. All right, next section. So that's your personal stuff. Next section. Here is your income section here. Wages. So on your job, you would have your job number right here. And I'm not going to give a line, but I'm just going to what's typical. Your job income here. Right here, if you notice it says business income. See, that's where we typically get that business income that you're asking about. You actually put there. Actually, you put the net. You put the net of expenses, income minus expenses, and you put the net. Okay. Yeah, you put So on the Schedule C form, which I'm gonna show you next, that's where you figure out what's the actual net. So take your income that you made, take your expenses, subtract it, and that net is what you bring over to this line. But I'm gonna show you that form right now. It'll make sense in a second. Unemployment income, you put it here, and it acts as, you add it all up, income. Pretty straightforward. Any kind of adjustments, healthcare expenses, like if you're a teacher, right, you pay for kids' pencils and stuff, you put it there. Stocking and things. Always very simple one. This one is a big one. I'll show you that later. Any kind of tuition costs, the standard adjustments. You may have some of this or you may not, right? Then, remember I was talking to you about the itemized deduction? And I said most people who have a house would be able to use this form, remember? This is the form right here. This form attaches to the one I just put, to the 1040. But most people don't have this form. That's what I'm trying to tell you. Because look very carefully. Here, it says medical expenses. You have to have a lot of medical expenses to get it. 10%. That's a lot. Most people, most of my clients that come through, I've probably seen one time, maybe twice, where somebody really got this. But it's deductible. Taxes. So this section is, if you pay property taxes, on your house, you put it there. You can, sales tax, you can deduct some of your sales tax, that get it up for it. Interest that you pay on your house, mortgage, that's that section. Here's where you put your charitable contributions, remember? So if you're not using this form, you don't know where to put it. And most people don't have this form. Okay. All right. So, job expenses right here. Job expenses. So if you're at work, if your boss tells you, hey, go drive down the street and pick up some supplies in your own car, then you can claim some of here. But if that's all you have, then it might not be enough for you to use this form, right? So all of that stuff should add up to more than your standard deduction, is what I was telling you earlier, for it to make sense when you use this form. But anyway, I just wanted to show you the form. This form now, the number at the bottom here, total, will go back onto your 1040 form. All right, so now let's go look at some scenarios with people in business making income and the ones who are not making income. So Schedule C, business owners qualify for hundreds of deductions that employees cannot receive. If you own a business, you can use the Schedule C, whether you are standard or itemized filer. These deductions are to be filed on tax form Schedule C and reported on individual standard or itemized filers 1040-912, which I showed you before. So let's look at the form. You're the designated button clicker for me there. And that comes up. Thank you. All right, so now this is a scenario filled out. The other sheet was blank. This is an example of an employee with no home-based business. Okay? Now let's look at it. It's Joseph work, married, the wife, address, social security numbers, they're married, they got one kid, and see, their total exemption is 3. Okay? Joseph works for AT&T Wireless. He makes $75,000, so we put it in. He has nothing else, which is, average. Average person, this is what it's going to look like. It's probably.
That was quick.
All right, thank you. So typically, that's what it looks like. That number carries down to here. You notice there's nothing on line 12. Let's keep going. No adjustments. So that number is actually your, what they call your adjusted gross income. If you heard of AGI, that's what it is. That number carries to the second page of the 1040 form. Okay, 1040 form, second page. There it is. Here's where the deduction is going to start coming in. Okay, 7 now comes and they give you itemized deduction or standard deduction, whichever is bigger. Remember that itemized deduction form? Whichever is bigger. Now let's go look at which one did they get? Standard or itemized? Standard. How do you know? Right over here. See right here? Because they're married. If they had gotten the itemized, then that number would be bigger. Okay, cool. So then now they're going to subtract these two. What's that? 62? Line 42 is the exemption. Remember where the exemptions come from? It's number 3 from the front page, because it's 3 of them on the tax sheet, multiplied by 3,900 or 3,950 or whatever. See? And it should be 4,000, as you said, 4,000 this year.
Yeah.
So that number comes up to 11,700. So man, they're getting some deductions. That's good. But you don't want to get taxed on 75,000. Please don't. Tax me on something lower. So what's left? Your taxable income. After you do all those subtractions, 5,100.
Your number's wrong there. You have 11,700. It should be 11,850.
Okay. Yeah. Somebody is covered up is probably calculated it or rounded it up or something. Yeah. Thanks. But see, 5,100. So now guess what we do next? We go to the tax tables to find out, based on that taxable income, what is my tax liability? Listen, and we're done. Of course, you go down to the bottom and we'll show you what your refund is and all that. All right, let's look at the other example. So this example is going to show you. Wait, before I do that. This person did not have it's the same example, no home business, but they didn't get to use this form. Remember? They took the standard. Remember? This is empty, so we didn't fill this out. So really, this shouldn't even be here. All right, now let's look at the other example. This is the same guy who decided to start my econ. Now he has a business. Same family, same kid, same job. Don't quit your job yet. Keep that job. But now look, he's got minus 1,500, 15,000. Because what did it say? Read it for me.
Business income or loss.
Or loss. That's exactly right. We didn't create this one. Now, let me jump down to, no, let me not do it here. But look what it did. You subtract this away from 75, you just lowered your income. That carried over to, actually, that carried over to, or it comes down to this line 22, but there's something else that we just did. This is set or simple, which is like a 401k for business owners. So you can go ahead and tuck some of the money that you made into that to even further lower your income, lower your taxes. So let me stop here and jump to Schedule C. Yeah.
If you're funding your 401k from your job,
Right.
you also fund.
There's some restrictions on that. Which I can't answer. I need to go read some of that. There's some restrictions, and if your spouse you have a spouse and all that, there's someone that you can do. Yeah.
I have people, I'm a certified financial planner, so I have people
Cool.
that so I go out and group. So if you need some help, I can help you.
Cool. Very good. Very good. All right. So now let's go down to. I want to show you the Schedule C. And I'll come back up to the top. So here's the Schedule C. All you gotta do is put your name and all that good stuff. Look, you can use your Social Security. People say, do you need to have a tax ID? Not really. Look, they put it right there. Social Security. Principal business. What your business, if you want to do that. Look, you don't even have to have a business name. It's a business name. If no separate business name, then leave it blank. Is that funny? But if you have a tax ID, you can always put it here. Okay, so on this form, here's where you put your income. Okay? If you made, over the next 12 months, you made $5,000 in my econ, then you put it here. That number carries down, all the way down to here. Now let's look at the expenses section. Now this is what we've been talking about all morning. When you drive your car, you're gonna get what? 57 cents this year. Well, that might equate to, well, if you drive 10,000 miles, which is easy to do in Texas, that's $5,700 in deductions. So that translates to money, okay? So you put it here. You know what's other categories? Advertising. Not everything is going to pertain to you, but you may have advertising. In this case, depreciation. So, you know, simply put, if you have items that will last more than a year or so, you know, some furniture and, you know, TVs and all that good stuff, guess what? You can depreciate it here. So if you're in your home, you have an office space, and you take some equipment and you put it in that office, guess what? Tax is the tax deduction for you. Okay, depreciate it and put it there. Another big area is interest. Interest, right? So you can deduct interest. You know, I'll show you that in a minute. But if you drive your car and you have a car payment, let's say you do 60% of your driving, and that's business related, then 60% of your interest is deductible. Put it in. Yeah.
If you have two businesses out of home office in two separate locations, can you put everything on this one form? Just one.
Well, if the businesses are the same type, so I know people who have multiple marketing companies. Like that, you know, I could see you putting them both together. But let's say you do, you know, you're a plumber over here, and you know, over here you make gift baskets. You know, I probably do two different schedules. You know, but just, you know, whether you put it on the same or not, at the end of the day, the numbers will typically be the same. You know, generally speaking. But yeah, I'll separate it in that case. Okay, cool. Where we at? So travel. You know, you travel around town. Travel is really if you stay out of your area, stay in a hotel, stay overnight. That's considered travel. You know, you put the expenses there. If a plane trip, like for example, I went to Boston. Before I went to Boston, I actually cousins there. I called my cousin Myron. It just so happened that I went during Thanksgiving. I said, Myron, when I come up there, I'm going to show you something that's going to blow your mind. So I went. And after Thanksgiving dinner, we took Myron into the living room and I showed him. Of course, it blew his mind. But guess what? I was able to deduct my car rental, my airfare, the whole thing. Right there. Next. Meals. That's a big one. You know, you eat lunch with your friends and you say, look, I can show you how to put an extra, you know, $500 in your paycheck or whatever. That's business. Guess what? You deduct your meals, right? You put it right there. Now, they'll give you 50%, they'll give you half, but I don't suggest you try to do the math. You don't try and divide it in half before you give it to your tax preparer. Just bring it to your tax preparer and he'll do the math for you. So just, all you gotta do is get good at collecting and tracking your expenses. Just keep collecting it.
Is there a limit on how many years you can pay the loss on the business?
Okay, good question. So you always hear like people say, oh, you can only live for 3 years or something like that. A company like Amazon and TWA never took care of profit until after 11 years, right? However, the IRS is not, you know, they're not stupid. They're pretty smart. So if you, for example, you know, you're in business for, you know, 5 years, okay? And you have expenses of $25,000, and you never made one red penny. They make money. I just say, how is it that you have $25,000 and you never made $1? Not even $1? They may have a discussion with you, right? So, right, but there's no hard and fast thing that says, if you're in my econ, you must make a profit. You have to make at least $1 before 2 years or 3 years or whatever. You know, it's not a hard. It's when they're talking with you, it's an interview. You know, and they look at all kinds of things. They look at your records. They look at do you have any marketing material? Are you really in business? They look at all kinds of things before they determine, right? Well, let's look at this scenario. Let's say you started my econ this year, and you know this is new for you, so you didn't make but I don't know $100, but your expenses was what? 25,000. The rules are this: if you have the intent to make a profit, the word intent is literally there for this reason. Let's say your business was you had a barber shop, okay? And today you went in your barber shop and the floors are swept, the lights are on, but guess what? It was sleeting outside, so people can't drive to your barber shop. So nobody came, no customers. Are you able to take business deductions that day, even though you didn't make any money? No problem.
Yes.
Yes. Because you had the intent to make a profit. You can't control the customers taking money out of their pocket and spending it, but you can make yourself ready to to get cash, etc., etc. And do business, right? So it's not just a one-dimensional thing, That kind of makes sense.
How far can you go back and file amended taxes? Like if you didn't file last year, year before last, and you wanna file it this year, how many years can you go back?
Well, typically you want to go back. You can go back 3 years. Typically, if you owe them, however, they can go back. They have the right to go back. They can go back, and especially if they see something kind of funky, they can dig through and they can go back. But 3 years is typically what it is. I got a statute of limitations out there. Cool. All right, I got to speed up. They're telling me I got to speed up. So where are we? So now here's the deal. After you get all these expenses, total expenses was 20,000. And what was your income? So now you do the math, right? You got negative 15. So that's why you had that on this line. Y'all get it? So now we subtract the 15 from his AT&T income. And you're left with this. Now, you're able to now, if you want to reduce your taxes somewhat, you can open up a simpler set, okay? And you go, bam, drop some of that income on here. And what is that going to do? It's going to adjust it even further. See that? You want to make this, there's what you call above the line deductions. You want to get as much of that as possible. When my clients come to see me, I'm like, look, this is what you want to do. People saying, how can you pay zero tax? How can you pay only that little amount of taxes? They're thinking it's kind of far-fetched. And here's what I understand. It's what you got to do is learn how to reduce your taxable income. See? And that's what I help folks do. That's what we help folks do in my econ, right? So your adjusted gross income is now 55. You still get the same standard deduction. See that? Nothing changes with that stuff. You still get the same exemptions because there's 3 of you in the household. But look, it's now 3,100 instead of 50 or whatever it was before. See? So what that means is you finally start getting bigger refund. But of course, we're not going to wait the end of the year. We're getting it now. Because we're going to change our W4 and start picking up further. Why? Because we're on a mission. We got stuff to do with our money. Irish don't need to be keeping it. Right? All right. Now, coming to your question a little bit. Okay. I haven't answered it yet, have I? I knew it was in here somewhere. All right, this is another example with, this is the same thing, sorry. Let me jump to the next one. Let me now show you an example of somebody making a profit. Same guy. He got really good in my econ. Maybe it's his second year, He's got this thing down. He understands the software. He understands this thing. He's able to teach it. Watch this now. He's making 20,000. I'm sorry. It's a positive number here now. See that? This is what you want. People are like, oh no, now I'm going to pay a lot of taxes. Look, my income is going up. And they start to worry. I'm like, that's not something to be worried about. That's what you want to do. And if you stick around my econ long enough, we have investment classes we teach. Yeah, you get that. So now we're going to know how can we do this kind of stuff. You see? Or if you have a financial planner or financial advisor, guess what? Now you can have a conversation with that financial planner or financial advisor. But before in my econ, you weren't understanding investments and investment terminology. So you can go to the financial advisor and they can put you in something that's better for them than for you. But now you're able to have a conversation. See? Because they're not all equal. Am I right?
Say that again?
They're not all equal. Not all financial advisors are equal.
That's true, that's true, because not all are certified financial planner, which is like a bar degree, but, not all are equal.
Isn't there a maximum amount you can put in the separate simple?
There's something
I
to
think
take
it's less than 20,000.
It may be, but I can't tell you from just this.
Right.
But it may be. But this is for an example to show you what we can do with some of your money.
Right.
You know? So we throw some numbers on there. That's I think maybe.
You can put up to 42,000 in a set. You're thinking about our IRA.
Yeah, raise limit.
Yeah.
Is lower.
I mean, it's tax advantage. It's tax advantage like some of those accounts you're thinking of. Right. But it's not exactly the same. But yeah, we have investment classes that go all day where we break some of these stuff down.
So for people making a lot of money that don't have a home-based business, they're limited out at their 401k at work.
Yeah.
They just get a home-based business, they put up to $42,000 more.
Yeah. Exactly. Yes, indeed. So you see what happens here now is, let's look at the second page. Well, again, we brought it back to 75,000. Even though he made all that money, we still brought it down back to what he made on his job. And it's back at 51. Right? Let's go look at the supporting Schedule C form. That this was made out of. Same guy, same everything, except now he made $40,000. See? That's what he really started out with, 40,000. He got the same deductions. So the deductions didn't really go up more necessarily. About the same. But when you do the math, 40 minus the 20, you're left with 20. And that's why we brought that 20 to the line 12 on the 10. Oh yeah, we have people doing this full time. Doing 6 figures. All over the country. Yes, indeed. And you know what? I like the approach. I really love the approach that we have in my econ. Because it's, I probably overuse this word, holistic. It's probably not even a real word, but we use it anyway. But, you know, it's not just, hey, come on in and sell some product or some service, you know? It's come on in and get your finances in order, holistically. Taxes, income, expenses, debt, investing, the whole thing. You know? It's not this one-dimensional thing where go sell and make money. And go sell and make more money. And let's forget about all the taxes going out the back door. And, you know what I mean? So it's a multi-dimensional type of operation. Yeah.
How come the IRS and tax preparers aren't teaching this stuff?
That's a good question.
Let me tell you.
For the IRS, there's a book that I have in my office. I forget the author of this book. There's a book that I have in my office, and one knows it. That's called, the title of it, I'll show you somebody this week. Probably you. It says, what the IRS does not want you to know. And I forget it's about this thing, and I forget the author of the book. But, you know, they can hardly keep the lights on the IRS office, much less start teaching this stuff here. But you know, I tell people, if you have tax preparer friends, if you know people that do taxes, you tell them, look, I got something that can help you probably double your income.
Yes.
Because they have a bunch of clients coming in who have no businesses, right? And they need one, as you can see. So if that tax preparer understood that, and you brought them a business too, yeah, that's huge. What a good question. All right, I've got to speed up. I keep saying that. So let me go. If you have questions, stop me anyway. Schedule A form. We'll put that Schedule A form in there, but in these examples, we don't use it. All right. Okay, so this is just, was just explaining what I already explained. All right, let's look at record keeping real quick. Record keeping. I don't know if there's a picture of the software actually in here. All right, we can look at some of these guys right here. Okay, so there are over 400 and something, 400 and I don't know what the number is, deductions that you can take as a business owner. However, we can just look at the top 7. You don't need more than that. You can even deduct your dog if you know what you're doing.
Security.
And these things are based on case studies. If you got a home business like your house and your dog and security, market, every time somebody comes to the door, this is a deduction. Deduct dog food. But we don't need to go there, right? We don't need to go there. We can just use these. Look, all these things. We spoke about some of these before. Contract expenses. Can you please see? I think we should have the actual. Here are actual forms for you. All right, publication 463. If you guys want to know where's this stuff coming from, where's this information, what makes this thing legit? Well, what we've done is we've packaged. We've gone into the IRS tax code and we've pulled out what we need to help us in business, right? And we package it so that the average person don't have to go digging around and they're just going to give up. The tax code is really thick. Now, publication 463. Travel, entertainment, gifts and car expenses. Let's kind of browse through this a little bit. Some of this stuff I already told you, but let's go look at it in detail. Now, if you go to irs.gov, you find it. I love that IRS put a picture. They even drew it out for you. Look, if you are in business, well, first of all, let's look if you're not in business. This is your home. That's your job. If you drive from your home to your job, what does it say? Never deduct. Right? I love this picture. But if you leave your home and you make a temporary work stop, then you go to your job. What does it say?
Always deducted.
See that? How many of you seen this page before? Okay. You look like you might. All right. But you know what? 9 out of 10 people have never seen this. They don't even know it exists. We want to teach this stuff. Now watch this. How do you do this? How do you apply this? One quick example. If I leave my home, if my home is right here, and my job is right over there, Fort Worth, Dallas, Fort Worth. I leave my house in the morning, and I stop right here. And I get my morning cup of coffee, like I normally do. And I say, John, how's it going this morning? And John says, good. Here's your coffee. I said, John, you have any referrals for me? Remember, I told you I'm in business, right? Get my cards right here on your counter. You see those cards all the time on the clerk's counter, don't you? It's there for a reason. So I'm in business right here. Now John's gonna tell me, yeah, you know that guy came in yesterday and he was complaining about taxes, and I gave him your card. I said, good. Here's some more because I know this stuff is depleted. I just did business right here. Okay, the IRS says that section is not enough. But now from here, this is it. To here, all the way to here, is a deduction. 57 cents every mile. You understand? It's a double-headed arrow. So on your way home, it's the same thing. So you stop right here at a happy hour after work. You're talking to your buddy, you know, say, hey, man, I went to this meeting on Saturday. This crazy Jamaican guy, you know, talking to me about money. Show you how to put an extra $500 in your paycheck? We need to talk. You just did business, didn't you? Okay, what is he going to ask you? He's going to say, how do you do that? How do you do that? And he's going to say, you know what, I'm going to call you later. And then what you do is you get on the phone with your business partner who brought you business, and you say, hey, you got to call this guy, my coworker. He's interested in this thing. He wants to reduce his taxes. And then it's all right. But let's talk about the deduction. From this point, as this, you go, actually, yeah, you go back home. That's a deduction. 57 cents, all the way forward and back home. Right? There are multiple ways of doing it. Some people, you know, they created a mailbox and they stop at their mailbox. You know, I never did the mailbox thing, but they created a business mailbox where all their business mail comes to that box. And they stop there and they check it every morning. one thing that I used to do when I just started this was there's an apartment complex really close to where I live. And I would stop there every morning. And I would make sure that the flyer that I put there yesterday was still there on the community notice board that I put. Yeah. And on that flyer, it said something like, underpaid, overtaxed, give me a call. And my number's on the bottom. Pick the number up. These days, people take a picture of your cell phone, so you don't need that. But guess what? That was my first stop, temporary work stop. Boom. And then from that point to my job, when every morning I would drive back, I didn't even have to get out of the car. Because all I need to see is that the sign is still up there. But one day I went and they ripped it off. Because you know they do that all the time, right? So guess what I did? I put my car in park, take out a new one out of my glove box, went out, and I stuck it on there. It took me like 1 minute. Because I'm doing business. That's a problem complex. There are a lot of people who come check their mail right at that little section, don't they? Somebody's gonna look at it and say, man, that's me. Let me call this guy. And they pay me now because I'm in pursuit of profit. I have the intent to make a profit. See? That's why I love when the IRS write intent. Anyway, and that's true. You want to really do business first. Business first. Because that's what you're trying to get. The tax, you hear me talking about tax deductions and tax benefits and all that. Look, that's the gravy. If you treat this thing right, that's going to be the lower part of the income you're going to make. Dallas has a lot of money in Dallas. This is not just about Dallas, but I'm just talking about Dallas since I live here. There's a lot of money in here. And people understand that they got to do something different. And if you tell them that you got something like this, they're going to do something. People are going to do something. I guarantee you, they're going to do something. So put them in business. You get paid. And it's going to make the tax deduction look like child's play. I have some properties that I bought using the tax strategy. Because I lowered my taxes low enough that it gave me $1,000 that I used to send to the IRS. I used that as down payment, closing costs, the first house. I'm coming to you. Okay. I use it as down payment, closing costs on the first house. Put renters in it. Then I have my income strategy every year. So guess what? I have the same amount of money coming next year. So I was buying a house every year. Not a house that I have to fix up and get contractors and flip. No. I've got a house that's ready to be ready. Maybe I need to touch a paint, but I don't have time to go look for contractors. Now, I'm not saying that you have to go buy houses, but I'm saying get your money. Yeah.
I want to know the same scenario you said. How about if your home is the how about if your home is your home-based business, and then you go to your flower? Can that be business to business?
If your home is your home business.
And you said you went to to see if your flower is still up there.
Yeah.
And could that be business to business?
Yeah. Is that your only place? You don't have a job anywhere else or anything?
That's how if you have a job, then you going to your job.
Okay.
Could that be business to business and business? I mean.
No. Okay. So the question is, so it depends on the scenario. Are you actually going to work that day?
Yes.
Okay. If you're going to work that day, then the miles that you drive from your home to that first stop is not deductible.
But that's if you just have a home and not a home-based business.
A home, but not a home business.
I
see what I'm saying? Talk to me.
What he's saying is, he is in business, he has a home-based business.
Right.
So he's leaving from his home-based business to his job.
Yes.
So he's done business, like if I'd have made phone calls, call someone, and then I get in my car from my home-based business to go to work, what about those mileage?
Yeah, it's the same thing. It's the same thing. Yeah, it's the same scenario. Okay. Because all of us have home-based businesses.
Right.
Yeah, my econ is a home-based.
So we reiterating how important it is to have a home-based business, because you're leaving from your home-based business every morning if you're working at another job. Right. So you're going to get to deduct those mileages. So exactly. I'm safe.
Right. So that's a good question. I mean, we're all
great.
We all have home business. Yeah.
I think he's saying so. The home right there is my income.
That's your home business.
You don't stop at the apartment. You just go straight to your regular job. You can't write those off. You still have to stop.
Some people say, I don't want to bother with all that. Well, your money. I gotta make it do it. I bought some houses doing that. That's another thing. Look, it's the system, I don't know, I look at it, I have the benefit of, I'm not the only one in this room that has this, but I have the benefit of two different perspectives. I'm from Jamaica, you know, yeah. You been there? Yeah. But, you know, we don't, I have two different sides of the coin, you know? If you can't make it happen in America, you can't be in America. America can do it, I tell you. You know?
Now, if you don't work a full-time job, you say you join, home-based business 100% of the time. So, 100% amount deductible? Or do you just take a percent? Like, would you take off mileage, say, you go to church or go grocery shopping? But when you go grocery shopping, you can still.
Correct.
Yeah.
Yeah.
It's never gonna be.
Yeah.
What is the safe thing to do?
Your mileage, most of your mileage will be deductible. There's always some little rules in there.
Yeah.
But most of your mileage, what are you talking about? If you leave your home and you don't have any other thing, and you drive from here to Houston, right? That's a lot of miles. And you went there for business, that's a deduction. You understand?
But still,
It's that percent for the car, unless you have two cars and you the only driver. Now, if you have two cars and you're the only driver, then you can designate one car as 100% for this.
Yeah.
But if you got more drivers in the household, it's traceable.
Yes, you, go ahead.
or you just make an estimate and say, hey, because I'm doing this person.
Right. So what I would advise you to do is, if you have one car, like you drive every day, I would advise you to track the portion of that, of those miles, that's business related. So every day is the best way to do it. Every day you check, you say, what's my odometer? There's a bunch of apps out there, I think, where based on GPS, it will help you determine real quick. I used to talk to Ivy about that too. See what kind of build that into our software. But there's a lot of
There's a
apps
software out there that on your phone.
Yeah.
If you just say, I'm here now, and then you go to your business, and you just say, I'm here now, it'll automatically track the miles and put it into the software.
Right, right. So I think it would be good to have that integrated into what we have.
So if you have a contract labor,
I can't remember the name of it.
what is,
I'm gonna
what
talk
can
to
you
Chris.
deduct?
I just saw it last week.
Contract labor.
Contract labor?
And they get you from work, get you from your house, and then you do the work after. What can you deduct?
And you own the business, or you don't own it? You don't own it.
Your contractors and everything.
So therefore, how do you get paid? On a 1099 or the W2? Probably 1099. If it's a 1099, then you have some deductions. You can deduct miles. But there's some room, yeah, you can deduct miles. It's not like you get 1099, you're not W2. And you're independent, it sounds like.
Let's say there's somebody that drives me,
Okay.
and, they pay the driver, premium. Is
Yeah.
that a deductible?
And again, if the, is it your car?
No.
It's their car. So you wouldn't be able to, you don't have any car related expenses. They only drive you. So if you pay them to drive you, then that's deductible. If you fee them, then that's deductible. But the expenses of the car itself is not deductible.
Right.
So it's like a taxi.
Right.
If you pay a taxi cab fare, then and you're doing business, then that is deductible. If you give the taxi driver a sandwich, then you can deduct the cost of the sandwich. You understand? So there, a lot of those things are deductible. Make sense? All right. So let's jump off of this page. If you look in your back office and your Micah website, you'll see everything that's in there. And here's a tip: look for these little dotted line boxes. We kind of put the lines around what's kind of important for us to read. I mean, you can take the time to read the whole thing if you want. Car expenses. Let's go show you some of it. All right, look at this section right here. Mileage. You may be able to use the standard mileage rate to figure the deductible cost of operating your car for business purposes. 2013, it's an old one, it's 56 cents. So in January here, by February, I think Ivy will have the guys at the corporate office update this to this year's document. But in 2013, it was 56.5 cents. This year is 57. See right here? Interest. Remember I told you interest can be deductible? Look, if you are an employee, you cannot deduct the interest you pay on your car loan. This applies even if you use your car 100% for business as an employee. So if your employer says to you, as a part of this job, you have to drive with your own car to pick up some supplies every Monday, you can't deduct it. Can't deduct it. Because you're not in business. Make sense? But look what they say. I love this other word that the Irish love. However, if you are self-employed and you have to use your car in business, you can deduct that portion of the car that's related to your business. Example, 60% business, 6% of your interest is deductible. That's here. Y'all get that point right here. Car expenses, you can either take the miles or the actual expenses, not both. Now let's look. See that? Speak to that. You can deduct the rims you put on your car, the license, registration, oil, tolls, parking fees. Okay? Make sense? Normally, I tell people miles typically will give you more. Unless your car is worth a whole lot. You know, you got the latest model or something, then you probably might do it. Because depreciation is part of the part of it. All right. Let's look at a couple more. The IRS has some record keeping rules. You can read it, but the software that Ivy created with the computer software engineers is based on the requirements, right? And if, for those of you who don't know, we have the little app that you can put on your phone that Mike can create. You can snap pictures of your receipts, you go to lunch, and you put log your miles and log all the expenses. Basically, you click on the drop down and you select the category that you're trying to expense. It's your minute. Put it in. At the end of the year, you have it all tabulated in a sheet. Print that out, give it to your tax preparer. You say, I'm a business boss. Now, each record that you put in there, if you took a picture, that picture stays with that record. So if you have a receipt, you can throw a receipt away if you want. They're going to fade out anyway, right? But now you have that little icon with that picture, and you click it, boom, receipt. You don't have to keep receipts over 75 bucks. Under. Thank you. Yeah, under 75 bucks. Make sense? But you got to keep records. All right, let's go down. Looking for something. Yeah,
Well, I'm thinking about sales tax, keeping my receipts for sales tax purposes for self-employed.
Self-employed. Yeah, there's a couple places to get sales tax.
I just heard some people say they keep every receipt that they ever get because they can get the sales tax back.
Yeah, right. There's another place too where you can get sales tax in the Schedule A form. But yeah, you could keep that as well.
That could add up.
Yeah. Oh, what am I looking for? I wanted to show you the entertainment expenses. Sorry, bear with me for a second. So some of these right here are some rules of record keeping. You guys can read that if you want. Okay, let me start with there. There's some rules of record keeping. You know, you should keep proof. Keep it in a diary, logbook. Some truck drivers will have a logbook in their truck, so they record all their miles, etc. Because whoever owns that truck is going to try and guess what? Deduct that later on. So truck drivers are familiar, or people who are in trucking, they're familiar with that kind of stuff.
If you have a big motorhome and you're going across country, would that be your home base business?
That's a good one.
That's a good one. Yeah, I like that.
Yeah.
Because you said a lot of
Yeah.
You meet a lot of people.
Yeah, that's cool. That's all it is. If you're in pursuit of profit, we're gonna find a way to deduct it. You know? All right. Because you know the IRS tax code it works like this. They'll tell you this and this and this is doable. However, You know, there's a whole lot of howevers in the code, right? Let's say, however, if this is the scenario, then you can only get 50% of that. And if you live in a foreign country for 6 months and you come back, then you can't get any of it. And it's like that. So when you put a scenario out there, sometimes I can give you a general answer. But until we look at your exact scenario, it's dangerous to say yes or no. But generally, motorhome, doing this kind of business, I can see it being deductible.
Yeah, it's your home.
It's an office. If you're prepared,
It's your home.
Okay. All right. So interest expense, I already showed you that. So what I did was he broke it out, and he did a good job of that. He broke it out. It's the same document, but for every item that he's talking about being able to deduct, he shows you and puts a box around. He puts a box around that item. So when you're looking through this at home, and you go on your website, I'm just letting you know this is how you should read. Look for the box around it, and you get to it real quick. So it looks like it's repeating, which actually is, but okay. This document is called Publication 334, Tax Guide for Small Business. Okay, so this has another set of rules in here, talking about Schedule C. You can't deduct stuff that's personal related. It gives a lot of examples. Talking about interest again. I need to get another section. Communication expenses like cell phone, internet access. Okay? This one here is publication 535. See? And it's under the section called other expenses. See, he got an index in there and everything. Go to iris.com. Here it goes, utilities. Business expenses for heat, light, power, telephone services, water, sewer are deductible. However, any part of your personal use is not deductible. You see that? Some people say you can deduct your telephone. Well, yeah, telephone can be deductible. But there's some rules on that too. If you have 2 lines in your house, then one is dedicated for business, then you can deduct that one. If you have 1 line in your house, then the rules change. See? So there's general answers and then there's specific yes or no.
What about repairs?
Repairs repairs there's a category, there's a line that says repairs on the Schedule C. And let's say you have to repair your computer that you use for business. Boom. Definitely. Or any tool or something that you use in your business. Then big time. Yeah.
What about your roof?
Your roof? Your roof, your lawn service, your pool service, your painting your house, your carpet cleaning, all of that is deductible if you have a home business. You might not qualify for it based on your situation, but it's deductible. Typically I tell people to stay away from that if they're not carrying a profit. If you're carrying a profit in my income, like one of the examples I showed you, making 40,000, then typically I want to stay away from trying to claim home office expenses. Yeah.
Right. But if you entertain in your house, it's really expensive.
If what?
You entertain in your house.
If you have your thing in your house?
Entertain.
Yeah. So typically what I say is, if you have a home party, you brought some guests in, you cooked up some chicken and some rice and whatever, and that for sure is deductible. That's meals. Any expense that you incurred for that activity is deductible, right? But if you're trying to deduct the lawn care because you had somebody come cut the lawn that morning, that goes with what I call home office deductions or expenses. Home office expenses, real quick, is the square footage of your house is this. Your room that you call your office is this, right? That ratio, that's what they use to determine the percent of your pool and your lawn care and your roof and all that stuff. That's how they determine how much of that is deductible. It's based on the square footage of the entire house to the square footage of your office space. But there's some rules on that make it deductible, but not that what you may not qualify for it. Make sense? But
Did you
every
say-
scenarios are different.
Did
Yeah.
you say you may not qualify based on your profit ratio?
Yeah, typically, if you're not carrying a profit, then it's not deductible for you. And that would mean if you come up with a negative on your Schedule C, that's what I'm talking about. You don't have a profit.
Oh, I see.
Yeah. Make sense?
And so if you have a cell and, a landline or whatever, that's considered two, correct? No.
That's two different things, really. If you have one landline at your house, that's not going to be deductible for you, but your cell phone is. Now, if your landline is a dedicated fax line, then it's a deductible. You see how the rules can switch on you?
Yeah.
So,
And the IRS did rule that if you have a landline and a cell phone, and you're using your cell phone predominantly for business, you can deduct 100% of your cell phone. But if you only have a cell phone, you're gonna have to track personal versus business. If you
Right.
only have a cell phone.
Right.
But you can't deduct your home phone, you gotta do one or the other.
Right. Exactly. So, and that's why I was telling you, whatever that percentage is that you use your cell phone, 80%, 50%, whatever it is, make sure you know what that is. Make sense? All right. Cool? All right, let's keep going. Let's roll. Utilities and all that. All right, meals and entertainment. This is what I want to show you. It's probably one of the last sections. Meals and entertainment. So, okay, right here. What entertainment expenses are deductible? Entertainment includes any activity generally considered to provide entertainment, amusement, or recreation. Examples include entertaining guests at nightclubs, at social, athletic, and sporting clubs, at theaters and sporting events, and yachts, and hunting, fishing, golf, and trips. See that? Who wrote the laws? Congress. Congress wrote the laws. They're all in business. They all, shoot, you know that y'all is at the CEOs talking about making deals right now, the golf course. And they deducted. The Cowboys, they're AT&T Stadium out there, Jerry World. They got these suites. They got these suites all around the stadium. What's that for? Yeah, Verizon, not Verizon. There's a company that supports them. I remember they used to work with. Cisco. I think it was Cisco Systems. They have their routers and stuff. And they would rent a suite at the American Airlines Center. Yeah, for the basketball. Yeah, they rent a suite. And they would always bring all the Verizon IT guys there at some point during the season. So, because they're in business, they're entertaining so that they can get Verizon to spend some money and buy some routers and some switches from them. You guys, you see this stuff going on around you. But only the business owners can do it. You see it when you're at your office and you sit at your desk, if you have a desk. Everything that your eyes fall on is a tax deduction. This telephone that's on your desk, the desk itself, the laptop they give you, the floor, somebody cleans it every night when you're home. It's a deduction. So we know that business expenses exist, but typically most people don't have a system and a way to apply it in their own lives because they're only employees. So we gotta educate people on how to take advantage of it. All right. What left? What's left? Travel expenses. That kind of goes without saying. There's huge areas that you can deduct in travel. Airfare, stuff. Travel meals, entertainment. See? You guys get the gist, right? So, on your own time, just take some time and go in your back office. You log in, click on documents. When you scroll all the way down to the bottom, you'll see all this tax information. Everything that I have here is what I'm looking at. You can take your time. I will be here all day for me, everything in here. But you see that? You can deduct your meals, lodging, car, dry cleaning when you come back from your trip. People say, I can do my dry cleaning. I know some people who wait until they have all their dry, oh, one second. They have all their dry cleaning, they keep it over here, and they wait till they go on a business trip. And then, when they come back, they wear that suit, take everything and they go dry clean. But typically, dry cleaning is not just deductible, you don't go business. People ask about clothes, can you deduct your clothes and all that? No. Depends. If you have your business name on your clothes, like some guys will have right on the sleeve and they have the name of their business or right here. Because the IRS is going to be that clothes. If you can wear this to Uncle Bud's funeral, then guess what? That's not a suit that you can deduct from business. Right? Uniforms are deductible. Uniform. Yeah.
What about hair? What about getting your hair deducted cut?
Well, are you doing it for business? Well, it depends on what your business is. If, let's say you have a hair salon and you're trying to show a particular style, and so you did it specifically to show your clients, hey, this is the new thing, then I can see a way to argue this deduction. Now look, if you get audited, first of all, don't be scared of an audit, okay? An audit doesn't mean you did something wrong. It means substantiate what you claim. That's all. And I represent people in audits. I have. You go to the audit. In one case, one guy didn't do my econ. By the way, you guys are lucky because we have the software now. 6 years ago, we didn't have software. We had a thick book, a binder about this thing. And in it was 360 pages, 65 pages, every day in the year. And on each page, I literally would sit in my car, I look at my odometer, and before I make a trip, I write it down on the thing. And when I get to the end, I write down the end miles, and then you do the calculation, and that's the miles. On that date, if I purchase a meal, that day, there's a section to write the meal. If I purchase a book because I wanted to read something on financials, I write it there. You understand? And there's a line for everything. Next day, new page, boom. And we kept that record. At the end of the year, we would have to add up all that stuff and figure out all the categories and stuff, and then we deduct it. Now we got a software that does the whole thing. Now, in this particular case, this guy got audited. His name got put out in the hash, and he went in and he had that book with his records. And would you believe that all he did was open the book up, and the auditor saw that he had his records. It's kind of like country Irish. And he's like, okay, you can go. Yeah. Because they know that some people are lazy and they don't want to take the time to keep their records. That's the biggest thing. But when they saw that he had his records, audit was done. Didn't even happen. In other cases, they wanted to examine a couple items on the tax returns. One to examine the years entertainment, one to examine the miles. And if you have your miles and your records, then you're good. You walk out just the way you want to. I don't owe you, you don't owe me. So, here, and all of the scenarios that you can come up with, in some cases it might be deductible, in other cases they may throw it out. You're going to have a conversation with the auditor. It's not a computer you're sitting in front of that looks at your records and then say, you owe us. No, you're sitting in front of a human being and they have a conversation with you. So explain to me, the fact that you're in a hair care business, why do you think that you're doing your hair is deductible? If you can talk your way through that, then you're fine. I've seen that happen.
I had someone tell me that you are your brand.
Right, that's what you were saying. Right.
So I mentioned, and I got a little confused, so I asked in one of these classes.
Yeah. And if you can explain that, and the thing is, it's kind of subjective too, right? So one auditor might let you, one auditor might disqualify it, one might thing. So I would like this. Know what the rules are, and go all the way up to that line. Sometimes you can bend it a little bit, but be prepared to talk me through, right? But don't leave it on the table. I prefer to go all the way up to that line. I'm going to get everything. But I'm going to do a good job keeping my record as well. Understand? Plus, the IRS is struggling right now. They're struggling to keep the lights on. Yeah, just rent it, right? Yeah.
How did you put another $1,000 in your pocket?
How did I put another $1,000 in my pocket? For tax purposes, doing taxes and all that? Well, what I did was,
Usually you fund your rental vehicles.
oh, yeah. So what I did was, so my tax liability before I got a business, was, in one of the years was, 10,000, right? So remember I explained to you how that's your liability based on the amount of money you're making, your spine status, all those things, right? So boom, 10,000. I got a business, and first couple of years, or second year, third year, something, I don't remember. It was 25 to 30,000, something like that. Was my net. It was negative 30 or 25,000. Okay. So when I did my taxes, I got 7,000 difference. So I used to pay off 10. Now I only paid 3 because of the tax deduction. So that left me with 7. I took that 7 and I used that for down payment closing costs on the first house. Put renters in it. Next year I did it again because I still have the 7,000. I think I probably added a couple thousand from my own savings or whatever. But the house that I buy, you buy 3-bedroom house, 2 bath. You're not gonna buy a mansion. You buy something a little bit easy to rent, right? Yeah. So, and real estate is another piece. So I don't suggest that people just go buy real estate. But the point is that I was able to get some cash. So the concept is this: cash, assets, cash. Yeah. If you're not building assets, you're on the wrong road. Yes. Sometimes we get impressed by people driving nice cars and living in nice neighborhoods, and we look at them and we're like, man, you got it going on, right? And I'm like, well, let's talk about assets. You might have a higher income because you might be the senior director or the VP of your company. But look, the last 36 months should prove to you that those people can lose their homes too when they lose their job. You drive down some nice areas and you see 9 big houses in foreclosure. They lost their job. But guess what they have? Their lifestyle is up here. Right? So don't be impressed by that stuff. Talk about assets. Look, we work so hard for this cash that we tend to hold on to it real tight. Not understanding that cash in your hand doesn't do no good. You want to convert that thing into something of value. This hotel is something of value. It's an asset, right? So it's a mindset thing too. We try to help people think differently because we're so conditioned to thinking that we're so conditioned with this employee type mindset. I gotta go every time I want my money to grow. I gotta go work some more. Instead of let me take this money and let it do the work for me. Let's work smarter. Work from the neck up. See? So, all right. So where are we? So travel. I'm sure we're near the end of this thing. Wages. This is a big one. All right. Wages. Do you know that wages is a deductible item? Typically. So on your job, when you get paid $60,000 next year, your employer will take that $6,000 and put it on his tax return and deduct it. Okay? So the point is deductible. Can somebody press that? It's all right. So it is a deductible item, right? All right. How do you apply it in your own situation? Well, there's something called income shifting. Where you take the money from one pocket and you put it in the other one. But before you put it in your other pocket, you pass it through your 13-year-old kid. Call it wages. Then you put it in your pocket. See, when the people in this country use this strategy to pay for weddings and college and banquets and stuff, right? Because what you're doing is you're going to hire your kid in your business, pay them a wage. See, don't call it allowance or shoes money or whatever you pay for your kids. Ballet lessons. Call it wages. And then to make it even more legitimate, what you do is You put some flyers in your kid's backpack. And when they go to soccer practice, you tell them, son, you know your friends these flyers. Tell them to give it to their mom. And what does the flyer say? Same thing. Underpaid over tax. Give me a car. Somebody, one of the soccer moms gonna call you. So the kid is working for you. Or when your kid comes home from school, they're gonna be on the street riding their bicycle. So you're saying, look, go put some of these flyers on these doors down the street. Here's some elastic and a little, sticky tape, whatever, stick it on there. I pay you. Oh, really? You pay me? Boom, they're gone. So what you do now, you open up an account, a custodial account. So you both have access to this account, and you write your kid a check. How much are you gonna pay them? Well, you have to decide that up front. So you decide, I'm gonna pay my kid $6,000 for the year. You know the kid is gonna cost you more than $6,000, right? Because they leave the light on all the time. And they leave the water on, and then they're looking in the mirror, singing and all that, with the water running in the shower, right? So they're gonna cost you a lot of money. That's right. Right? But let's just say we're gonna give them $6,000. And I'll show you why I use it up to $6,000 a minute. You decide every month I'm gonna write them a check. 6,000 divided by, divided by 12 months. 500 bucks? 500 bucks you pay them every month. Write a check. So you have a paper check with a carbon copy. This is for doing business in my home-based business. Okay? Now, you stick the money in that account. You got a debit card for that account, right? And then when it's time to pay for light, shampoo, gas, you buy it from the same account. So it didn't cost you anything more. The same money. You're going to spend it anyway. But what did you create? You created a business expense called wages. They pay for colleges. Look, wealthy folks did not get wealthy without doing this kind of stuff. They understand strategies and concepts like this, and they apply it. You understand? That's how wealth is created. We all want to be wealthy, but we don't want to do what wealthy folks do. It's easy in this country, relatively, because there are examples of it being done. Just look and copy. There's so many books written. There's so many people that you can talk to. Ivy Stokes over here. I lean on this guy. Say, Ivy, how do you do this thing? For years, I've been picking his brain. Yeah.
Is it the same with your grandchildren? If their children are adults and say, yeah, was to have my granddaughter?
Sure. Oh, yeah. Most definitely. You can. Right? So now, and this is really beneficial if you're going to pay that person anyway. So in other words, if you're going to spend the money anyway, think of ways to make it business related. Make sense? Yeah.
Oh, I was just thinking when she asked the question, what about the grandkids? In my situation, I'm a grandmother, so when my grandchildren come and visit me, I'll have to watch them or keep them. It's business. And then my daughter is in my time, so they live with her. So everything is business there. So they have 2 employees, Mimi and Mommy.
All right. So here's where this document is where it's showing you. Because people sometimes you sure you can do that? I've had a couple of CPAs in one of my workshops. 2 different occasions. A couple of CPAs. One of them was like a junior guy just finishing his studies and all that. And this is some years ago. And I normally get my business card, etc. So he called me when he got home, and he said, you can't do that. And I forget what it was. Something that I was showing him that you can do. He was like, you can't do it. And then he says, according to my book here, he's looking at some book that he was studying from. He's like, can't do that. So I said, I really don't remember, but I said, show me what you're talking about in the tax code. Because that's what I use. I go to irs.gov. And then he never found out. It's funny though, but like I said. So sometimes we have to read this stuff, or we should read this stuff to bring up our belief system. Because when you're talking to folks about this, that's what they look at. If you're talking to somebody and say, you can increase your income by applying a tax strategy, but you don't sound confident in what you're saying, or you sound unsure, like, they're like, what you got yourself into? So read up on this stuff, so you know what's real and what's possible, and then get better at it by practicing, right? And then now when you speak to people, you speak with confidence. I'm like, oh, okay, let me see what you're in. Make sense? So this is how you get your belief system up. Watch this. Employee pay. You can generally deduct the amount you pay your employees for the services they perform. They may be in cash, property, or services. It may include wages, salaries, bonuses, commissions, or other non-cash compensation such as vacations. Then you deduct it, right? Benefits, fringe benefits. For more information, read on. So what am I showing you? That wages is deductible. So in case they didn't know, yeah. Question.
Is there an age limit on the wage that you pay to your grandson who's 5 because you're paying his tuition for school every month?
Right. Okay. So when I read a little bit further, you're gonna see them make reference to age 18 and all that good stuff. However, again, I'm gonna go back to my default answer, which is some things might be, not everything's equal. Have you ever seen, driving on the highway, ever seen a billboard on the side where there's a picture of a baby, and maybe they're advertising Gerber baby? That's somebody's baby, right? Do you think somebody getting paid? Yeah. Somebody's getting paid. We just need to figure out how to get there.
Yeah, exactly.
You see? But if your 4-year-old was paid for going down the street and putting flyers on somebody's door, then they might throw that one out, right? Yeah. See my point? So my suggestion is, this is my suggestion, is if your kid is, 8 years old and out, teenager or whatever, they can go down the street. They're up and down the street anyway, right? On their bicycle and the skateboard and all that. They can do business with it. They can wash the business, the family, the business car, which is your car. They can wash a company car, right? Well, a 2-year-old won't be able to wash a company car. You see what I'm saying? You got to be reasonable. Right. So the IRS says if it's ordinary and necessary, right? So it's not ordinary. I know they use those exact words. It's not ordinary for the 2-year-old to have wash a car, right? Generally speaking. Exactly. I'm telling you, the tax code is just like that. What you got?
As a 2-year, I have a grandson that's 2 years old, and like, oh, he's so cute.
Yeah.
Put a button on and put a T-shirt on, and he's now advertising your business.
Right. Now you may have to pay for like photo studio time because you have to take a professional picture for that kid, right? So you see what I'm saying? There's so many angles to work at it. And if you can talk through it and give the IRS a reason why I needed to do this in order for me to grow my business from here to here. You know what I mean? If you can prove that to them, then you're good. I went to Jamaica. Me and my kids and my wife went to Jamaica in 2009, and I did after that trip. So when I was down there, I stayed at my parents' house for a little bit, and then went to the hotel. I was like, I'm gonna go live like a tourist in my own country. So I pulled up my white socks and I was up here, and I put on my fanny pack and I had my camera. I looked like a tourist. But anyway, no, that's kind of kidding about that. But while I was at the resort, a hotel, drinking stuff and all that, you have all kind of guests at the hotel, right? Some Europeans, some Americans. They always find Americans, right? They like the vacation, right? So they're chit-chatting on the beach. This guy and his wife were from Dallas. I told him, the government is paying for half my trip. How do you do that? I said, when I get back to Dallas, I'll give you a call. Right now, I gotta go snorkeling. So I got his information. And then, guess what I did? I went back, gave him a call, talk to him. You understand? I'm always business-minded. I'm serious about my business. You see? Now, my econ has a travel we have a special deal with Priceline.com. Plus, we have deals with Travelocity and the rest of them, or you name it, we got it. Now, we are referring travel agents. You probably don't realize that. Because you can refer your clients to your website for them to get airfare and you get paid, right? So you're in the travel industry. Okay, I'm explaining something to you. I'm going to explain this to you this week. If you fly to Italy, what's that? Aruba. Good one. If you fly to Aruba, right? There's such a thing in the industry that they call familiarization. That word is hard to say. For sure, I said family, but it's familiarization trips. In the travel industry, it's ordinary and necessary and accepted for travel agents to fly around the world to visit resorts. Wow, resorts. Come on. Right? To check out the rooms, and sometimes the hotels give them for free because you're bringing business, okay? So they go and they check out the rooms and this, and they stay there for a week or two. Come on. Guess what? When you go back to Dallas, you want to be able to tell your customers, Aruba is a good place, stay at this particular hotel, I did that. Guess what? Yeah, the whole trip. So what we're showing you is what's possible. But there's some howevers in there. You understand? I didn't deduct 100% of my trip to Jamaica. I did half of it. Because I could explain why I say half. You know, I've got my kids there. I paid full price for their tickets. But they're not 2 years old anymore. So they're not, a part of, their part of the expense wasn't necessary for me to do business. You know what I mean? But my wife entertained the wife of the guy that I was talking to. Right? There she was. So because of that, I'm deducting her part. That's right. Because if not, the wife is over here thinking about, come on, honey, we gotta go, dancing or something. Like, no, we got business talking about that. So I tell my wife, go here, talk to her about, shoes and handbags and nails and stuff. We're already talking business. You see? So, all right.
So how does your travel, excuse me, how does your travel if you were to go on a mission?
Mission trip?
Right.
Are you volunteering your time?
Yes.
So you're not doing it for profit, right? So that's going to be a charitable contribution. That's charitable.
How much do you deduct from
I don't know. All of it. I guess. I think so. I've never had a limit when I'm doing it. I think all in. Yeah, absolutely. The whole thing. You can drive your car too. If you're not in business and you drive your car to the soup kitchen to help out the homeless, and you do that religiously every day or whatever, you truck your miles. That's deductible. Hmm? But if you're not having a schedule C, you probably don't have where to put it. So you might not qualify. That's right. Yeah, not qualify. All right. Let's move. Man, I spent so much time on this. What time is it? Somebody else. 11:30? Yeah, you guys need a bathroom break? Yeah. All right, you guys be quick. 5 minutes. 5 minutes, really quick. I think the bathrooms right now.
Yes, it's
sunshine?
She's still having dinner with this week.
Yeah, that's what I'm saying. There's a where, 3 months for that.
But
tired of getting
Yeah, and that's, yeah, that's what I'm saying. I haven't heard of it, like,
So your total that was.
there's software in the iPhone that, anytime that I do something, it's connected, you don't have to go through some digital side. Oh, yeah. Yeah, that's what I'm